Hey, what's going on, everybody? It is Tuesday, February 1st. We are now in February. So long to January. All right, we had a pretty good day, up day again in the market. Let me start off by saying, I think this is still a short covering rally. I'm still staying negative or cautious, and I'm going to give you my reasons why. First of all, it's not surprising that the market is bouncing because in January we saw bearish sentiment rise to the highest level in 9 years on that AAII weekly survey. I mean, it was really extreme levels of bearish sentiment. We saw put-call ratios get highly elevated. I mean, the put-call ratio, if you look at the 10-day average and the 20-day average, I mean, they got as high as what we saw back in the March, April 2020 pandemic crash. So really high levels of pessimism and worry and bearish sentiment. So it's normal to see a rally in under those conditions. I mean, when you have extreme levels of sentiment like that, it's normal to see a rally. But the other reason I'm staying cautious or defensive is because I'm still looking at the fiscal flows. Now, the month of January, we averaged like 446 billion for the month. Okay, basically we're averaging around 22 billion a day. All right. The problem is, those were the flows. That was spending of 440 billion a month, 446 billion a month. The problem is we ran a surplus of 20 billion in January. So even though the government was spending 446 billion a month, it was taxing 466 billion a month. So all that spending was basically taken away. I mean, it flowed into the economy, then it was taxed back. We ran a 20 billion surplus in January. And I think that's going to continue. So here's the problem that I see. All right. Right now, we do have a deficit for the fiscal year. It's like 467 billion the last time I calculated it. And again, if you want to learn how to do this stuff, just buy my course, Understanding the Daily Treasury Statement. And it's a video course, and it'll teach you how to, break down all these, all these things from the Daily Treasury Statement. You could calculate this yourself every single day if you want, like I do. So here's the problem, right? We're running like a 460 billion deficit for the fiscal year. The problem is now on a monthly basis, the government's starting to run a surplus. There's 8 more months left in the fiscal year through the end of September, right? So if you take 20 billion times 8, because now we're running a 20 billion surplus, we ran it in January, I suspect we're going to run it. I don't see any reason why it's going to suddenly go away, because the taxes are way up here and the spending is like, it hasn't gone up. Actually, it's come down from like December levels. So I think the surplus feature that we are now, or the surplus environment that we are now operating in, I think that's going to stick around unless, they pass some new bill. But I mean, Manchin today, Senator Manchin just said the Build Back Better is a dead issue. Forget it. That's over. So here's the thing. If you take that 20 billion a month surplus and you run it out for the next 8 months, okay, that's 160 billion. If you subtract 160 billion from the current deficit of 460 billion, you're left with a 300 billion deficit for the year, for the fiscal year. And you might say, well, what's wrong with that, Mike? It's still a deficit, right? Aren't you for deficits because that's a transfer to the non-government? I say yes, but just consider this. A 300 billion deficit is like 1.3% of GDP. I mean, we literally went from like a deficit of like 12% of GDP last year down to like nothing. I mean, a 1.3% deficit as a percent of GDP, that's basically like saying we have a balanced budget. And I just don't see that as being enough to sustain an economic expansion. I mean, I just don't. And without an economic expansion, the market's going to have a really hard time because, you're talking about a slowdown in corporate profits, and there will be profits, but you know how that will occur. That will occur as a result of cost cutting. And what is the main thing they go to right away? Companies go to, firms, lay people off. That's the first line of cost cutting, is laying people off. And what happens then? Then demand comes down, consumption comes down, investment comes down. I mean, all that stuff starts to fall down. So I just don't see it. I do not see it. Basically we're running a balanced budget here. And who knows what? I mean, they still have to do a continuing resolution on February 18th. I mean, without we might have a government shutdown. I mean, the politics are so bad right now in the Senate. I mean, it's just like, it always amazes me how anything gets agreed upon right now, because it's a really bad situation. So that's the thing. You might as well consider this as a balanced budget at this point. And I do not think that is good enough to boost the market to new highs. I just don't. That's not enough of a fiscal pump, in my opinion. That's why I'm staying short. I'm staying negative. That's not enough of a fiscal pump. You need expansion. You need growth. Growth is what drives the stock market. That means increasing profits. Increasing profits with, bringing along labor and wages and everything else like that. That's a virtuous cycle. When you have expansion and people are making more money and profits are going up and companies have the capital and the wherewithal to invest. I mean, when you have a stagnation like this, which is, I think, what it's going to be. I don't think, I'm not talking about some kind of a crash. I mean, crashes don't really happen unless there is really some kind of a technical catalyst that causes it to happen. At least not in recent modern times. I mean, the crash we had, the COVID crash, when everything got shut down, the 2007 to 2009 great financial crash, we had massive reserve additions by the Fed. I mean, the Fed really created that crash. If you go back to 1987, that was portfolio insurance and that kind of stuff. But I mean, I think this is more of a situation of economic stagnation. We could have a market kind of like this, choppy up and down. I don't see it doing very much, and I see more opportunity actually on the downside. Now, if you're a long-term investor, which I always advise people to, have that view or take that position as a long-term investor, use that as your strategy, then it's good. I mean, if you have patience, you can buy good stocks as they come down in price. Like I was a net buyer of stocks for my own portfolio in this pullback on January. All right. And I'll continue to do that. But, at the same time, I'll trade around this. Like when the market rallies now, I like to put on a short position because I think it's going to pull back. I mean, for me, again, when I look at the fiscal situation, and in particular, when I see the surplus feature that, is currently happening right now, I mean, it just says to me that's not enough fiscal to sustain an economic expansion. Now, I could be wrong, but I just don't see how corporate profits are going to rise without some significant cost cutting in this environment. Let's see what happens. But I mean, right now, I'm saying on the record that I think this bounce is a short covering rally. I think it's coming off of a very oversold situation where there was intense bearishness. And don't forget, and I mentioned this yesterday, the Fed's going to raise interest rates. Right now, the market is pricing in 5 rate hikes this year. I've heard there were articles saying 7 rate hikes. I mean, I'm looking at Fed fund futures. To me, they're saying 5 rate hikes this year. You know, and again, those rate hikes, I mean, we're lucky right now because household debt burdens are low, historically low. I've been talking about this. But those rate hikes will boost up debt service burdens pretty rapidly, I think. So that's something to consider. I mean, I've been saying like bank credit could support the expansion for a while because we're at low levels of debt service, you know, burdens. But I mean, that could pop up pretty quickly once the Fed starts raising interest rates. And by the way, in the last banking data that we saw that just came out on Friday, loans were down, okay? And that happened in a week that we saw another reduction in bank reserves, which should have been a positive development for the banks in terms of, you know, making new loans. I mean, that frees up space on their balance sheet to bring on loans as new assets. But their capital is taking a hit now because of the rising interest rates. They have $30 billion in losses on Treasury securities. I mean, that's hurting their residual, which is their capital, assets minus liabilities. So anyway, I'm still negative. I don't think the fiscal looks very good. You know, running surpluses, to me, that's bad news. But we'll see what happens. Anyway, that's it for today, folks. Enjoy. See you tomorrow. Bye.